we're now being joined on the show by Juerg Kiener, MD and CIO at Swiss Asia Capital, along with Prathamesh Mallya, the Deputy Vice President, Research Commodities and Currencies at Angel One. Gentlemen, thank you so much for taking the time out and speaking to us. Juerg, I'm going to come to you first. Help us understand the kind of rally that we have seen in the gold prices. It's a one-way rally coming in, a one-direction upsurge, if I could call it that. Now, amid chatter globally of rate cuts coming in from the US and eventually in India as well, do you think there are more legs to this rally?
Interesting question. Where do we see actually gold going and why? And I think we've got to look a bit at the history of what happened to the gold market within the last 2-3 years. Basel III, which is basically the International Bank of Settlement, was introducing basically restrictions on selling gold short in the market. So you needed to have actually full collateral. That's been forcing a lot of shorts people actually to buy back their shorts. And then we used to have now this war zone coming up where third-party risk increased, and that meant gold moved back to home countries instead of staying away in other exchanges. So what we have now is actually still a lot of outstanding contracts which can't deliver or they cannot deliver the right place. And the first part which I made, that gold is money under Basel III, it has as well a currency ticker. It can't default on the currency. And that's another reason why it actually moves. The debasement of money and currency printing continues to accelerate, particularly during wartime. So these two things are now the driving force, which continues to move gold up. And the third item, which just joined the party, is actually the BRIC membership structure, which is going live probably into a year end with the payment system, which is going to require probably a 40% gold or maybe partially alternative resources backing to settle trades. And that's going to mean that a lot of these countries which are BRIC members will continue to accumulate gold to actually meet the payment obligations.
Right. Good afternoon, gentlemen. This is Vinny joining in the conversation as well. And Prathamesh, I'm going to come to you. The quick question obviously lies, while we've seen gold see a rise, but, and we're talking about how we could see a further run up as well. How much of an investment or a portfolio should consist of gold now? Is it something as a priority everyone should be looking at it? And what is your view on the gold move?
Hi, good afternoon. Thank you for having me on the show. I think you just popped up some numbers in front of me. When you look at a shorter term time frame, just for this particular year, gold has clearly given returns in double digits. So looking at a shorter term time frame per se, you would probably allocate more percentage of your portfolio into gold. So in an ideal scenario, 10%, if you are a genuine, probable risk averse investor wherein you would want to diversify some part of your portfolio, it is 10%. But then in times of uncertainty like this, wherein you have a lot of things at play, gold is certainly one asset which actually rallies, and there is no stop to this rally. So in that case, the ideal allocation should be in the range of 10% to 15%.
So allocating 10 to 15% of your portfolio with gold is the word coming in. But gentlemen, stay on with us. We'll take it across to our technical expert, Kunal Botra, who's joining us with an in-depth analysis about gold prices and other precious metals as well. Kunal.
Well, yes, Snehi, thank you so much for that. Gold prices over the last, many years, we've seen that the prices for gold in dollar terms has consistently, risen. And this is the charts for gold prices over here. Now, interestingly, what we spot over here is that whenever gold prices have managed to scale past above the previous highs, the previous resistances or the previous highs, they've actually become support for gold prices over the longer term basis. So we come back towards a point where, gold prices in just a couple of years back, when it was almost at $1,500 to $1,700, per ounce mark, I think from that kind of a breakout zone, the supports for gold prices have been the previous resistances. Now, the best interesting part about the chart so far is that the current resistance, which is around the 2200 mark, as you can see on the gold prices, that's the fresh leg of a breakout which we've seen after months of consolidation, which means at $2,500, what we are looking at gold prices currently, we are looking at a fresh base or a support which could be almost at $2,000 to $2,200 for gold prices. And that's not the only interesting part. The better interesting part about the bullion asset class is that silver has started to get into a breakout mode. So potentially what we've been seeing over the last few years is that gold prices have started to rally, silver has underperformed, but it seems like the charts for silver are indicating that it's also on the verge of a breakout. So as you can see, this congestion zone of $30 to $32, this is a major resistance for silver. It's tried almost 3 or 4 times in the last few years to try and break past. My sense is potentially over the next 3-6 months, you should see one more successful attempt of this breakout of this $32 range for silver. This could be another asset class which could probably get back into a line of a very strong outperformance from here on.
Okay, thank you so much for that, indicating to us on the charts, Kunal, where gold, precious metals are looking.
Let's keep it going with both our guests, then Juerg as well as Prathamesh. And Juerg, I want to come to you now with a question regarding the central banks globally and their reserves of gold. We've been hearing China's central bank actively accumulating gold over the last year as well. So do you think this is going to have a major impact on global gold prices, and if so, how much of an impact do you think this happens, and in case this trend reverses, what impact is it going to have?
In all over the world, but particularly among the BRIC countries, will continue to accelerate as central banks will try to increase their amount of gold holdings and risk-free asset on the reserve currency statements accounts of the national banks. And as this global debasement of money printing continues, the central banks will be forced at one stage to create stability, to create an opportunity to continue to print money. And the only thing they have left on the balance sheet to create this trust will be a gold revaluation through that account. So they all want to go to higher levels. Most of them are somewhere between 2 and 4% of their asset base. And I think they're going to go at least to about 8 to 10%. And so central banks will continue to be buyers of that precious metal, which shines so brightly.
All right. Prathamesh, what I also want to talk about, while gold surely has seen that up move coming in, we're seeing silver too, that trend is catching up. What's your thought on gold versus silver, and how do we see pencil in both these now? Do you see that silver also would be something moving in tandem with gold, and the returns that we've seen gold give us, is that something we could watch out for in silver?
I think
gold
when
is
you
always
have comparison in both these metals, gold and silver has in comparison, it is an investment as well as industrial metal. And the kind of demand that is coming from the industrial side, specifically on the solar as well as green energy, I think silver's demand would definitely outperform for next few years. And if you look at silver's overall chart structure or say balance structure, it has been in deficit for past 4 years. And even in 2024, it has been in deficit. So looking at demand supply, industrial demand, as well as the investment demand, I think this particular metal has more room for much higher prices. But in comparison to gold, I think it is lacking in the perspective per se, wherein the factors surrounding gold are much capable of moving gold prices higher in comparison to silver. But then if you're talking about gold and silver both as a metal, you should at least have 5 to 6% of it in your portfolio, so that you are definite allocation in this asset classes called precious metals is better in comparison to other asset classes.
Right, I'm going to come to you for this as well. Similarly, I want to understand, gold, silver, Prathamesh is saying 5 to 6% at least of a portfolio should be gold, silver side that one should be holding. What's your thought on gold and silver, and in the silver up move as well? What are you watching out for in terms of triggers here?
I think the trigger has already happened this last couple of weeks. I think we've got breakout structures in all the underlying metals. If it's silver or gold, gold has been the leader, silver is the follower. Silver is the one which is going to be moving much faster as it accelerates in gold, because it's such a much smaller market. There's much more bottlenecks in the supply-demand structure as such. The absolute undervalued asset within the gold and silver space are the miners. They've been basically not making any money for, let's call it 12 years. And this boost, which we have on an acceleration in gold prices means that their earnings power is actually accelerating. And if you look at the last quarterly earnings, which came out of most miners, which were based basically on earnings roughly at 2,300, they doubled. And I think if you look, we are now at roughly 2.5, you can almost expect that these earnings will double again. And I think a lot of people are not really exposed to that. We still see people selling actually mining shares. We still see people actually selling gold and silver ETFs, which is actually unbelievable looking at the momentum and the firepower, which is actually in these charts and technical structures, but which is very well supported by fundamentals.
Okay, so that's the view coming in from you, but Prathamesh, help me understand the situation, right? Because on one hand, in the budget, you've seen a duty cut coming in on gold, and that is expected to bolster demand for gold. On the flip side, gold prices continue to hover near that all-time high. So on the back of both of these factors coming into play, how are you penciling in the consumer sentiment to look like when it comes to gold, given that we have the festive season, the wedding season just around the corner? What kind of buying are you expecting to see when it comes to gold?
The question is to me?
Yes, Prathamesh, please go ahead.
Yes, I think the 9% duty cut, and if you see the day impact when it happened, 9% to 10%, it declined on that particular day. But after that, gold prices had almost covered the extent of fall. So which means it has already covered 10%. So, and it is about to rise further, taking into consideration the factors surrounding this particular precious metal. But looking at it from a price perspective per se, if you are a buyer and you go to a shop and buy gold, it looks expensive at 73, 74,000. So for those who are physical buyers and possibly about to make a jewelry, I think they have to wait for price correction. But then if you're looking at gold from an investment perspective per se, it is better to diversify yourself into digital modes of investment, specifically ETFs and sovereign gold bonds, wherein these two modes gives you an option of exiting whenever you see an attractive price. So in comparison to physical, digital options are much better if you're looking at gold as an asset class from a returns perspective.
Right, I'm going to come to you for this. I want to understand, do you think that now it is some bit of a peak that we are seeing coming in for the run-up in gold, silver, or is it just the beginning of a run-up? Over the last decade also, you look at it, consistently gold prices surely have increased. We have discussed that as well. But are we around the peak at least?
If I look at the picture of investment managers, I think the average ownership of the metal in an institutional portfolio globally is well below 0.5%. So basically, most people don't really have an exposure yet. And you know how it is when things becoming really positive, more and more people will participate. So the big pool of money hasn't really arrived yet. The retail money in the West has been seller. It's been the Asians have been the buyers. And you can see that on the premiums paid, let's say for silver in China, it's $4 higher than in London. So that tells you that we have shortages. And these shortages are driven in the exchanges and they have to be met, which means we're going to need higher prices to square the book. So the international business as such will drive the price. It might not be the small Indian retail investor in this round. I think they will continue to buy with whatever they can do, which is great, even at higher prices. I think they will continue. But I think it's going to be the large institutional investors, which right now have nothing or hardly anything, which will increase their positions, like the central banks increasing their positions. And that will mean the prices will have only very short and shallow dips before it goes to higher prices.
Very interesting view coming there, Juerg. Thanks so much for taking us through that. But while we are speaking to experts about what to expect when it comes to gold prices going ahead, let's also go across and listen into another expert voice, because we also caught up with Peter Maguire, the Chief Executive Officer at XM Australia, where he shares what he thinks of the gold and silver uptrend and what he expects on both of these fronts going ahead. Listen in.
The gold to silver ratio, looking at the moment, it's at about 85 to 1, roughly. You're just under $30 for an ounce of silver and you're nearly at $25.50 for an ounce of gold. So you just do the math and it's about 85. I wouldn't be surprised for that to narrow over time leading into the end of the year. And I feel as though that there's movement up there for as far as silver to take another upward leg, and I wouldn't be surprised if it's significant. So silver's a very hot market to follow, and I think that and gold are going to be the place to be over the next couple of months.
Right. Prathamesh, I just want to understand in terms of when you're looking at investment methods, would you say that an investor should rather be buying gold jewelry, ETFs? What is the best way? That one could be looking at such an opportunity that you have, right? Because every time there's always a regret, at least in the Indian housewives, when you see that they want to just collect gold and every time it goes up, you're just watching out for that, then if you've missed out buying. So what is the best way that one should be looking at it?
See, in India, the accumulation of gold happens more on the physical side, and it is never looked at it from an returns perspective per se. It is because of digitization of this particular asset class, specifically into ETFs and sovereign gold bonds, wherein a lot of people have diversified into this particular modes and are thinking about returns perspective when they're investing in gold as an asset. So if you are choosing physical versus digital, I think the perspective of an individual with regards to risk and the need and desire of an individual are taken into consideration. Because in India, much of the consumption is physical based, I think the return is never considered. But if you're looking at from a return perspective, I think I would better be a buyer of sovereign gold bonds in comparison to physical gold, because it gives you interest at regular intervals and plus it is tax free, and you also get capital appreciation. So all these three in one asset class and digitalized method, again, that gives you a better option in comparison to physical gold.
The preferred way of playing this entire gold theme into your portfolio. But on that note, gentlemen, I'm going to thank you for taking the time out and speaking to us at ET Now. Prathamesh, Juerg, thank you so much for taking the time out today.
If you like this video, then like, share and subscribe to ET Now.